The video opens with a sharp warning. Everyone thinks AI is the future. But that is exactly what makes this moment dangerous. Start with the idea that every bubble begins with something real. The internet was real in 1999. Railroads were real in the 1800s. Housing was real before 2008. And artificial intelligence is real today. But the danger begins when a real technology becomes a financial religion. Investors are no longer asking which AI companies can make money. They are asking only one thing: who can attach the word AI to their business model fastest? The chapter should create the first hook. This is not a story about whether AI will change the world. It will. This is a story about what happens when Wall Street prices the future as if it has already arrived. Main emotional effect: curiosity mixed with unease. Now move into the historical parallel. Take the viewer back to the late 1990s. The internet was transforming everything. Email, search engines, online stores, digital communication. It was obvious that the world would change. But because the technology was real, people stopped questioning the valuations. Companies with no profits, no clear business model, and sometimes barely any revenue became worth billions. Investors believed old rules no longer applied. Profit did not matter. Cash flow did not matter. Valuation did not matter. Only growth mattered. This chapter should repeat the competitor-style phrase, "Sound familiar?" Then explain that the dot-com crash was not caused because the internet failed. It happened because investors confused technological destiny with financial reality. Main idea: the internet survived. Most internet stocks did not. This becomes the core parallel for AI. This chapter compares the language of 1999 with the language of today. In 1999, every company said it was an internet company. Today, every company says it is an AI company. In 1999, companies added .com to their names and their stocks exploded. Today, companies add AI to investor presentations and their valuations jump. In 1999, analysts said traditional valuation models were obsolete. Today, they say AI changes the economics of everything. In 1999, the market believed the winners would own the future. Today, the market is making the same bet again. The chapter should not say AI is fake. It should say the opposite. The most dangerous bubbles are not built on lies. They are built on truths taken too far. Main emotional effect: recognition. The viewer starts feeling that history is repeating. Now introduce the hidden mechanism. AI requires enormous infrastructure. Chips, data centers, energy, cloud capacity, cooling systems, network expansion. The market is assuming that this spending will produce enormous profits later. But this is where the dot-com parallel becomes darker. During the internet boom, telecom companies spent billions laying fiber optic cables because they believed internet demand would grow forever. The demand was real, but the timing was wrong. They built too much, too fast, with too much borrowed money. When the bubble burst, the infrastructure remained, but the investors were wiped out. Now apply the same structure to AI. Data centers are the new fiber optic cables. GPS are the new telecom equipment. Cloud capacity is the new internet backbone. And debt-funded expansion is once again being justified by future demand that may not arrive fast enough. Key line: the infrastructure may be useful. The investment may still be catastrophic. Main emotional effect: the viewer realizes the danger is not the technology, but the financial machine built around it. This chapter should become more intense. Explain that bubbles do not burst when everyone suddenly realizes the technology is useless. They burst when expectations become impossible to satisfy. AI companies are being priced as if adoption will be instant. Margins will be huge, customers will pay forever, and competitors will not destroy pricing power. But what happens if AI becomes cheaper? What happens if open source models reduce profit margins? What happens if companies use AI but do not pay enough to justify the infrastructure cost? What happens if energy costs rise? What happens if regulators step in? What happens if investors demand profits instead of promises? This is the turning point of the video. Use the competitor-style escalation. The first cracks won't look like a crash. They'll look like missed earnings, delayed data centers, lower margins, slower enterprise adoption, one guidance cut, one failed funding round, one major AI stock that suddenly stops going up. Then the dominoes begin. Main emotional effect, tension, and inevitability. The final chapter should deliver the big twist. The AI crash, if it comes, will not mean AI was fake. Just like the dot-com crash did not mean the internet was fake. The internet became bigger than anyone imagined. But most of the companies from the bubble disappeared. The same could happen with AI. The technology may survive. The productivity gains may arrive. The world may genuinely change. But the people who bought the mania at the top may still lose everything. Final message. This is how history tricks investors. It gives them a real revolution, then convinces them that every company attached to that revolution deserves an infinite price. And with a strong closing warning. The question is not whether AI is the future. The question is who survives the gap between the promise and the profits. Because in every bubble, the future eventually arrives. But not before the market destroys everyone who paid too much for it. Main emotional effect. Serious, memorable, slightly chilling.